Either you're a day trader or going long-term, we got you covered, as in this session, market experts will share insights on what's next. Please welcome on stage moderator James Hughes, Group Head of Marketing at Scope Markets, who will introduce his panel. James, welcome.
Thank you. Thank you, everyone, for coming. As Lisa said, my name is James Hughes. I'm Group Head of Marketing at Scope Markets. I will let these guys introduce themselves. I will start off with Roger. Off you go, Roger. Please introduce yourself.
Good afternoon, everybody. My name is Roger Eskinazi. I'm the Managing Partner for Tickmill, South Africa. For those of you who don't know who we are, please come and visit us at the booth just around the corner. I think it'll be time very, very well spent.
And Roger, thanks. And Sai.
Hi, myself Sai Mahesh. I'm from ICM. We are a multi-regulated brokers from UK-based FC Regulations. So we have globally presented with the regulations, and we are stepping out into the South African markets. So what's happening to the business developments? I'm here to go. Thank you.
Amazing. Okay, thank you, guys. So we will start with
Louder.
Obviously, the key topic of discussion here is around markets, general market movements, and of course looking into Q2. So I think the first thing to start off with is in Q1 we saw incredible volatility in a lot of different areas, and that tends to be a very general point that everyone will say. If you get a talking head on CNBC or Bloomberg, they'll give you, we've had a lot of volatility here, we've had a lot of volatility there. That's looking into Q2, our key topic here is what's the alpha in Q2. But I mean, I suppose the best way to start is by a brief little outlook we'll start with you, Roger, for Q2 and what you're looking at specifically as the main drivers.
The amount of volatility in the market, I think you all have understood if you are trading, is something that we have to contend with on a daily basis. And it's a year that has started off very well, a quarter that started off very well, and once again, the ugly word inflation has reared its head. Now, I think to understand what's happening in the present, one needs to understand what's happened in the past. And I'll go back right to 1981. 1981, anybody know why that was a significant year? Other than the fact that I was 10. That was the year when the US 10-year bond rate was the highest it's ever been. The US bond rate was 15%, real return of 10%. And since then, over the last 40 years, the first time we've had an increase in interest rates was about a year and a half ago. So for 40 years, we've had declining interest rates. We've had stimulus, $10 trillion of stimulus during the global financial crisis. Another $7 trillion of stimulus, which did not go into the economy, so it's highly inflationary, just cutting checks to the public. And people are surprised now that we have inflation. It seems very strange to me that it comes as a surprise and that you haven't prepared accordingly for that.
Yeah, sure. And of course, inflation is that main driver, was the main driver in Q1. Of course, we've seen rates incredibly high. In terms of that inflationary picture, Syed, interest rates in some areas have begun to work. The interest rate rises have begun to work in certain areas to bring down inflation. In some areas, the UK being one of those areas, it's not working at all. I mean, what's your rate outlook for Q2? Where do rates go? The Fed said last week, that we were all on the outlook for the fact that this was the last in the rate hikes. The market had told us this is the last rate hike that we're going to get from the FOMC. And then Jay Powell said, hold your horses, I don't think it is. What's the outlook for the Fed? You can take the Fed. What's the outlook for that for Q2?
Thanks, James. Generally speaking, the major factors that drive the markets, like government policies, international transactions, you can say speculations, supply and demands. So if you see in that way, macro conditions, which also impact, which shows in the last 2 quarters of the markets, which been a serious evidence which we've seen in the market, like compared to the high inflations, as well as we can say about like rate hikes, which also a major impact which is this. So when coming to the second quarters of talking about the market's trends and strategies where to be the major factor which affect the strategies, where we look into like various kind of strategies to be adopted, depends on the sector wise. So while choosing the sector, which are the major sector which going to impact, which give the performance on the on a market trend moves, which we can be like checking out into the point of where exactly the performance is out of the stocks. So this is all like coming under the macro conditions, macroeconomic conditions, where I see that major focus to be on that particular point of sectors actually.
Yeah, sure. Roger, go on.
So I think for those of you who've seen the movie Groundhog Day, we've been here before. We saw it in 2001 when the Fed increased interest rates so rapidly, then reversed course straight away and started to cut aggressively. We saw it again in 2008, and we're seeing it again. One must understand that when you raise interest rates, and if you look at from the point of monetary tightening to peak expansion and inflation, we're talking between 18 months and 2 years before the effects are felt through. So to go month to month and try and raise a blunt instrument to curb inflation when the inflationary numbers that you're seeing from last month or actually from a year ago, it makes no sense. And the Fed is once again falling into the trap because they have no other ammunition left.
But why did the Fed start raising rates in the first place? Did they start, and not just the Fed, you know, we're looking globally here. Was it a case of they were raising rates to bring down inflation, or were they raising rates because they were so absolutely petrified of the post-COVID recession that if they didn't raise interest rates from these ultra lows, they'd have no bullets in the gun to fire to save the economies once they hit recession? Now that's not necessarily a problem, but in my opinion, I don't think the initial reason was that inflationary pressures. The inflationary pressures were there, but we needed the bullets in the gun to be able to save the economy. Now we're in a separate situation. Again, take those economies where rates have been raised, but inflation isn't coming down. Now, and Sai, maybe pass this to you, is the best situation in some of those areas where inflation doesn't come down, actually the way to now bring that inflation down when rate hikes don't work is actually to get into recession? You know, is recession and the collapse of the economy the only way that inflation comes down, especially in the likes of the UK?
So raising interest rates, it's a part of economic weather. So when you say about the Fed rates keep hiking, the main concern for the investors are to be more concerned about like how to reduce the risk as well as how to make profit out of the game. So if you say like, if investors focus on this kind of situations, majorly they look into like a fixed income securities where for a short-term period, and also like you could get into the dividends profit paying stocks, which also helps the investors to get into the risk, reduce the risk on the part. As well as like, you know, you can get into more on a kind of sectors wise where it can give the more performance on this kind of situation when there are high inflation and high interest rates on this.
So I think the answer to your question is twofold in my opinion. I think at one stage the Fed was so afraid of entering a deflationary environment. Looking at the 20-year history of Japan, you know, it's not a good place to be. And then, of course, all this inflationary stimulus. I mean, you're $17 trillion. You've now got this inflation bubbling over, and there's nothing left.
Yeah, sure. I mean, absolutely. And you know, where we see this going forward, we've seen the Fed do what it's done. We saw the RBA now completely come back into this and say, no, we're working to raise rates again. Where's the opportunities for clients? You know, what are people trading on now? We're on this, we're teetering on this. Will they, won't they, every single month? Because we've gone from, okay, we're sitting here, we're getting rate hikes every single time there's a meeting, and there's no question about that. Now we're going to have a few months of, well, will they, won't they? which creates volatility in the markets, in the run-ups. It creates all sorts of movement. Where are the opportunities for clients in these areas?
If you look at the Fed funds rate, you plot the Fed funds rate and you plot what the market thinks the Fed is going to do, there's a clear discrepancy there. So the market is saying, in terms of the forward curve, that inflation seems to have peaked and at least normalized to an extent which doesn't necessitate another interest rate hike. The Fed is now under pressure, as we've seen. The last interest rate of 25 basis points. You've had a couple of regional bank failures who really had bought too many treasuries at 0% and couldn't honor the treasuries when rates went up to 5%. So the most important thing now is to take a look back and say what worked during the last decade. It's not going to be what's going to work this decade, because this decade we're going to have higher inflation. I don't think we'll ever get back to the 2s or 3s. Let's say it moderates at around 4 or 5.
But they definitely won't take the target away. They'll still say 2% target rate, that's for sure.
Well, that's how they're mandated. They're going to keep that, stick their guns to that mandate. So what works well in a high inflation environment or in a higher inflation environment? Fixed interest is now starting to become interesting because that wasn't an option last year. You had to go and pay Deutsche Bank to hold the deposit. I mean, that's the ludicrous world we're living in. You had to pay the banks to hold money for you, negative interest rates. Now you can get a risk-free rate of around 4.5% in dollars, and that's a good starting point to build a portfolio. Anything you add on the portfolio, relative to the risk you take, must add alpha, must add performance over and above what you can get from the risk-free yield or the market. And certain stocks, certain sectors work better in an inflationary environment than in an environment of declining inflation.
Yeah. Okay.
Basically, choosing the sectors are more important things in this kind of situations, because all the sectors cannot be given the same kind of result or report. But basically, when there is hike in rates and high inflations, so basically choosing a different sectors, which also gives you a kind of output of giving the result out of it for a short-term period, basically, because it can be a U-turn for the interest rates to be changed over coming months or something like that. So this may more focus on that.
So I'll push you a little bit then. So where are these sectors? So where are these sectors? And I want to touch on a few bits as we go through a little bit later, because this sort of information is imperative for clients, retail clients. Understanding this and getting this sort of insight is key. And later on I'll touch a little bit on how that's so important. But in terms of these sectors, where should we be looking? Sai, if you want to carry on. Sorry, Roger. Sai, if you want to just elaborate on where you were there.
If we overall the markets, it all depends on the factors, the macro conditions, basically. So the investors are finding out the strategies where which factors really affect. So based on that outputs as well as result, or maybe the reports comes out of the individual stocks informations or company's performance, basically in that way you have to look into it. So but overall I think that market has given a different kind of phase, which after the pandemic, like from 2019 or 20 and 21, we can see 23 as well as, so which as well as like Russian Ukraine wars, or which other factors has been had in the markets over there. So which also helps like investors much more concerned about how to reduce the risk. That's one of the things I can say, where we can also look into the fixed incomes. That makes sense to the investors to focus on which sectors they can go for hedging the funds indeed.
Sure.
So if I had to build a portfolio today, and the way I like to look at this is if I had to build a tanker that'll withstand a tsunami, and that's how an investor, I think, should approach it in these markets. We'll start off with real yield. Where can you get real yield? The best place to get that is a reasonable allocation to TIPS, or Treasury Inflated Protection Securities. So whatever the inflation number is, whether it's 5 or 2 or 9, you guarantee to get a return above inflation. So that's your starting point. The next place to look is stocks with good cash flows, high dividend yielding stocks. I mean, you can go and pick a bunch of 10 stocks with dividend yields of between 5 and 7% in hard currency. Add that to your risk-free yield of 4.5%. The next thing you add to that is super cheap stocks. Super cheap stocks, as we saw in the 70s, where they're beaten down, they were out of vogue in the momentum cycle. We now looks like we're more tilting towards a value-based cycle. You add some of those. And then to hedge, you can add gold. We can talk a bit more about gold. And you can, the most important thing of all, above all else, and the only free lunch you can have is diversification. And that's on multi-levels. And we can talk more about that too.
Yeah, sure. And actually, you lead me directly on to gold. You know, gold's that key point. And we can all say here, and I don't know if this is in my opinion, it's a little bit old-fashioned that we talk about this safe haven aspect of gold. You know, forever and a day, everybody's told us, well, in times of economic strife, we go to gold because gold's a safe haven. You know, is that a bit outdated these days? Is that gold safe haven? Oh, there's a bit of this, there's a bit of that going on in the market. Interest rates are higher. We don't know this. Gold. You know. It kind of, we've all done these panels 100 times before, you know, and usually the last question anyone goes to, they go, well, what's your number one thing to look out for in the next 6 months? And everyone goes, well, they'll give a different answer, 444, over, I say gold, but for this reason. I say gold for this reason. And majority are about safe haven. Is it outdated to call gold that safe haven now, isn't it?
Look, some people will die with their beliefs, whether it's right or wrong. So gold has historically been given its accolades because it's a real store of value. It's supposed to act antithetical to inflation, so it's supposed to be an inflation hedge. It hasn't done that. I mean, you look at last year, gold was down. We had a terrible year in the market with rising inflation. The thing about gold, the one thing I can tell you about gold is there's certain times in the market cycle where you hold an instrument and certain times where you sell, irrespective of your style, whether you value or growth or momentum or quality, etc. Now, we know from history that gold tends to perform well when 3 stars align. 1, when the US dollar is weak. 2, when real rates are low. And 3, when the equity risk premium is low or it's overshot the mean. Now, that's why you're probably seeing gold had a bit of a run now. Once again, excess stimulus. I personally don't like gold, but I acknowledge that at times in the cycle, it's not a bad hedge to hold where there's lack of alternatives. I'm seeing lots of alternatives. I'm not seeing lack of alternatives in this market. And if you look at the stats, numbers don't lie. If you plot the gold price since 1980 against equities and against REITs, gold has done 300%. Global equities has done 3,000%, excluding dividends, and global REITs have done 8,000%. So if you're holding gold, remember, it doesn't pay you a yield, so there's an opportunity cost of holding it, and you get it wrong, it's an expensive lesson.
Exactly. What he's trying to agree with him basically, because in these situations, high inflations and economic uncertainty, the investors look for a safety kind of investment, which is only the gold. So historically speaking about, it has been proved that in this kind of situation, the gold has given the uptrend trend, which also looks as a safe haven for the investors to go for. And like you can say, the entire trend of the gold, whenever you see a market's negative side, or the first option where the investor look for gold as an option for that, I mean, to the investor on it, edging the funds into it. And moreover, if in the current situation, current details about like the factors which really affect the gold, affect the markets, it's like, again, the Russian-Ukraine war, high inflations as well as rate hikes, which also push the gold markets on an upside trend. So I strongly believe like this could be one of the best option to edge the risk compared to the other sectors of the markets to beat it.
Yeah, sure. And obviously gold is from a retail perspective, and we look at the amount of retail clients here at the moment. I think if we were to ask a question about, you know, where's the next direction for gold, just very briefly on that, you know, where does gold go in Q2? You know, what is our Q2 outlook for gold?
Our personal outlook at Tickmill is flat. It's had a bit of a run. We expect a period of consolidation, given that the Fed has said it's most likely to pause. So I would probably wait for further bouts of weakness to enter gold again. And as a personal preference, I prefer to play the gold miners with real cash flow as opposed to the gold price.
Yeah.
And if you've been invested in South Africa and the gold miners, I mean, you've done exceptionally well.
Yeah, sure. Sai, go.
Yeah, exactly, because it's based on the gold minings as well as like what kind of even central banks started buying from after the pandemic time. So that's also the most important point to be, key point to be noted. Like a lot of gold reserve has been come out even after the pandemic 2009. You can see that every year there's a graph rising on the reserves. So obviously this will push the gold markets to be an upside trend. Whereas like more retail investors also were participating on the gold markets, especially compared to the digital markets as well as in the metals like white, yellow metals. So these are one of the major keys which we can look into the coming quarters actually.
It's also important to remember that since 2015, all the BRICS countries have been stockpiling the gold reserves. And that's pretty much come to an end. So once again, you're seeing the latent effect of that in the gold price. So I think in conclusion, buy and hold for gold is problematic. You'll get in trouble. Trade it tactically and get the right data. Read the right data. Look for the right signals.
Yeah, sure.
Basically, it says that buy at the low price and sell it at the high price. So it's almost touched again the new high to 20, 70, 75, something like that. So obviously, it looks market corrected back again. Again, there's some other news will impact the markets to buy it back. As you said, do it in a short-term trend, which we can make good money out of it.
Yeah. So let's go from something which is old safe haven that's a potential buy and hold in Q2 to something which is a complete basket case, and we're looking at the crypto side. So we within the panel we're talking about within the intro we're talking about Bitcoin. So Bitcoin's movement, cryptos in general. If gold's buy and hold are cryptos and potentially and more specifically Bitcoin, are they stay away completely and keep your money safe in a locked drawer somewhere?
There's nothing more entertaining than a dinner conversation around crypto and Bitcoin. There's a lot of divergent views depending on when you bought and when you sold. So
people tend to buy on the guy in the pub's recommendation, right? Yeah.
So obviously at Tickmill you have the ability to trade cryptos as well as forex, indices, metals, and this is why I urge you to come and talk to us after the seminar or during the time tomorrow. Personally, crypto for me is still a highly speculative asset. We generally tend to stay away from it until we've seen more evidence that it has a place in the market cycle. As a tactical player, however, we have a position in an ETF called Block, B-L-O-K, which invests in the underlying blockchain technology of around 80 companies. It produces income, it's got cash flow, it's positive this year, and for us it just makes more sense to play the cryptocurrency game this way until there's more evidence that this thing has direction.
You mean acting on the back of someone's recommendation in a pub isn't the best way to go?
Definitely not.
Bitcoin, crypto in general, what's your view, Q2 looking forward?
Bitcoin,
and probably, in general.
Exactly. So if we talk about Bitcoin, again, everyone knows about it. It's the world's largest digital currencies, basically. Even recent time, it's almost touched 9-month high of $31,000, which also like in the consolidation way of trading within the 27 to 29, something like that. But when you say the trend of Bitcoin is always a question mark, unknown things to know about how it's going to be impact the markets coming days essentially. To honestly speak, like Bitcoin, like we've seen many phases, but we should forget about one thing, that it was almost trading at 60% low from the all-time high. So obviously there are opportunities there still, but same time we have to think about the downside risk, what exactly the market's going to be impact. So while looking into that point of view, because digital currencies has been developed with other industries as well, which has been shown many industrial, various developments has been shown along with the digital, so it's coming up with other industries. So obviously which also look into the major factors now.
We have a very astute Bitcoin investor in the audience, Trevor Fine, and he's an astute. Trevor, what are you down on Bitcoin at the moment, average? A lot.
You can be specific if you need to, you know.
So once again, it's be very careful. Always size your allocations appropriately. Don't play with what you can't afford to lose.
Yeah, sure.
Especially in crypto.
Yeah. Is it, in terms of crypto, so we talk Bitcoin, right? So there is this movement to altcoins all over the place, you know. This idea of that I'm cleverer than anybody else who's trading crypto because I don't trade Bitcoin, Ethereum anymore. I'm into altcoins all over the place. And instead of buying, you know, 1, 2, whatever it may be, micro lots of Bitcoin, I will trade on these tiny little, incredibly volatile altcoins, you know. There is is this the quickest way for a fool and his money to be separated? Either of you can take that first.
Yeah, look, I mean, if you think the ride's going to be wild on the bigger known currencies and you go down the value chain with these other cryptos, you can get wiped out. You can literally get wiped out. So once again, unless you know what you're doing, and don't listen to people who tell you they know what they're doing.
Because they definitely don't.
Ask to see their track record.
So
We should be very cautious and watchful when what kind of the Bitcoins as the move. So each and every time, like that's the most important thing to be focused by the investors. And as we know that it's evident as unknown factors, like what exactly the market's going to be impact. But make sure that you're being long time in the markets is always not a good sign. As you said, like even a gold as well is a safe haven. But still, if you say about the digital currencies, the cryptocurrencies, looking for a short-term trade, which also gives a more benefit than looking for a long-term way of factors.
Sure. I want to touch on something around what this sort of information, these sorts of panels, you know, we see these sorts of panels all over the place, you know, they're at every one of these events. We have various different market experts coming up and talking about various different points, the majority of which, scope markets included, not advisory based, not giving advisory information, you know, which is a huge part of this market, you know. So how important is this sort of information to retail clients? You know, this non-advisory but insight-based information. You know, how much should because a retail client can get bogged down in this information. There is so much. You can be. Every broker will tell you that they've got the best. Every broker will tell you to join their webinar and do this one or do that one, or read our analysis and don't read anybody else's. How do you cut through the shit?
It's a very good question, because there is a lot of shit.
There really is.
So the proliferation of all this information that empowers investors is a good thing and a bad thing, because there is so much information now, but it's the same like if you're assessing whether to buy Apple or Tesla. What are you going to make your decision on? What data are you looking at? The average investor, with the greatest of respect, who is not a professional, is not looking at the right data. You know, it takes years to train to understand free cash flows, to understand cash value to book, to make an informed decision of whether to buy. So everybody will try and sell you their book. And I think it's extremely important to find a firm that you can connect with in terms of the material available on their website that is legitimate, that's ethical, that has the ability to make you make better informed decisions, or find somebody who you can trade with or partner with that has experience and has a proven track record in times of stress and in times of good market performance.
I mean, absolutely. That the point around, you know, making sure that information on the site, looking through the educational content, you know, because there is often this, of course, misconception when there is education or insights, is to, well, why do I want to take insight and education from the broker that fundamentally wants to take my money? You know, so how do people decide? How do you get through that? You know, so how do you? Okay, you're looking at the information on the websites, you're looking at the content, but how do you bridge that gap between the fact of why do I want to listen to you? Why do I want to listen to you teach me how to trade when fundamentally you want my money?
Yes, with a small note, like you can say, if you're the best trader, the most important thing, like they have to be skilled themselves, to be practiced and disciplined from their educating knowledge from the outsource. Apart from this, there will be a self-skilled analyzers to be there, just blankly billing the outsourced informations or multiple information about from the markets and just trading based on that news, it's not actual way of trading. But want to be understand what exactly they have to be know what kind of news are being factored affecting the markets. For example, economic indicators, which kind of news which really impact the markets, which product which is going to be impact. So based on that kind of information is the most important thing which you're receiving from the broker side or a news side or any kind of market insights from you getting in it. So that makes sense to them to go into the long-term trends of this.
So let me give you an example of a consumer trend that's played out over the last decade, which is the rise of passive funds versus active managed funds. I mean, literally because of the factors I spoke about earlier, you can have thrown a dart over the last 10 years and you would have made money. Very, very difficult now. You can't do that now. $8 trillion left active manager funds to go to passive funds. Now, that in itself can be a bubble. And if you don't know when to get out of passive and when to be an active, that could also be a problem. So we certainly see this the next decade as being the return of the stock pickers. The ability when you've got everything, all your tailwinds that were there for the last 10 years have now become headwinds. You can't afford to be 100% invested in a passive strategy.
Absolutely, absolutely. I mean, I want to touch on something else around that, just deep into this a little bit more, is the influencer side of analysis in markets, you know. I mean, all of our companies, I'm sure, use influencers in our marketing strategies to you know, gauge interest, you know, get people's interest, get people's followers. We want social media strategies that get people in the followers. But in terms of the content they're delivering, it can be dangerous, right? Because there's a lot of this content that is out here that isn't necessarily regulated, number one, fine, but there's a lot of other things around that as well. How as a retail investor do you get away from that? How do you ignore that side of it and focus on the right things? Because there's so much, right? There is so much that you can get yourself bogged down into.
You know, I've seen stuff from influencers, and I'm careful not to tarnish everybody with one brush.
No, absolutely, you know.
Because there's another side to the story as well. But stuff that'll make the hair on your back of your neck stand up, that's downright both immoral and unscrupulous. I've seen other very good influencers who will hold hands with clients and let them understand that the quickest way to get rich is to do it slowly, and give them ideas and help them to be empowered. So once again, it's about finding the person, the firm, the platform with its chemistry, with its integrity, with its trust. And those are three virtues in this industry which has been sorely lacking. And as we see, you know, in a bull market, you can do anything. The next 5 years is going to be incredibly difficult. So be very, very careful how you invest your money. It's not easy to make $1 these days. Very easy to lose it. Lots of willing takers.
Yeah, and I like that point actually around you know, the best way to make money is doing it slowly. You know, we've always said over the years of talking to people in these situations is that the best traders tend to be the ones that understand how to lose money well. You know, that's one of the key points. Sai, how do you push to your clients that, you know, you need to lose money well and understand that you will lose money at some point? How do you get that across?
See, basically, like any traders have to look into the first most thing is like the risk management. So whether the influencer or getting educated from different source, we have to learn about the risk management, how to exactly use your funds into the markets. So and also like choosing the products wisely, like what kind of risk is involved in it. Because major of times the psychology plays here with the markets as well. So compared to you, what are the inputs you get outside, what are the analyses you do yourself, what are maybe, but again, it's a matter of psychological as well as the risk management plays here. So that's what I look into the major core which we can, as trader, have to look into this.
You know, if we look into the top traders we have at Tickmill,
yeah,
and we have a lot of professional traders, three things stand out on the ones who are successful. One is they position their bets accordingly. Second is they plan their exit before they even get in. And thirdly, It's about discipline, discipline, discipline.
Yeah. And from an educational perspective, that is the key point. I mean, I want to finish off. We've got only a couple of minutes left. I want to finish off just by, there is a fundamental question as to what our panel is. It says, what is the alpha in Q2? What should we be looking at in Q2? If we're picking something, we're going with one area. What is that alpha in Q2? Sai, start for you.
So if you say like the Q2, what we have been seeing on the Q1, I've not seen much difference compared to the market's trend, or maybe we can say the market's volume as well as, because the factor which moved on the other side on the day, the first quarter and second quarter, which I feel is the stable way on this way. So quite looking on that point of view, where I feel like which will be also a positive note for the investors. So look into kind of growth patterns to be adapting new strategies, which based on the various kind of impact in the markets, which also helps them to come out from this kind of a negative trend on the markets, basically.
Sure. Roger?
I haven't got a straight answer for you. What I'll tell you is the S&P 500 now is around 3.8, I think. I think the possibility of it reaching 4.2, 4.3 by the end of this year is a possibility. And it's also a possibility that it'll go down to 3.2, 3.3. So once again, it's about timing, it's about diversification, buying instruments that will give you yield, buying sectors that will give you opportunity to get in, good energy stocks, energy infrastructure, defense. We've got a big position in defense stocks, given that NATO's agreed to spend 2% of GDP on defense. It's currently 1%. There's big spending coming there. Dividend stocks and short, small cap, middle cap stocks with good quality companies, good cash flows that have been beaten down. Put that in the mix. Be patient, be disciplined. You won't go wrong.
Amazing. Guys, I mean, thank you very much, both of you, for your insights here. I don't know if you just want to, Sai, where's your booth? Just which number booth are you at ICM.com?
So we are at booth number 6.
Booth number 6. Roger Tickmill.
15, I think. Booth number 15. Yeah, got it. 15. Please come and visit us. We've got some very, very smart people. We've got some great ideas. And there's a lot of stuff that we can do together.
And Scope Markets are booth number 1 in the middle as you walk in the door. Thank you, Roger. Thank you, Sai, for your time. Thank you, everyone, for staying and listening. And enjoy the rest of your day. Thank you.
Thank you, guys.